Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to pivot a little and go to an education piece. During conversations with most of you, my clients, my friends, I get a lot of questions related to different financial topics. And I realize that many people probably are often asking the same questions or similar questions. So I'd like to be your guide as we can go through some of these topics. And as a result, I'm adding in educational pieces for our Women in Wealth series. If you think of a topic or questions that you would like me to discuss in our Women in Wealth series, please send me an email to reginahess@forgewealth.com. Don't be shy. Other people are most likely curious about the same topics as well. So today we're going to talk about the topic of RMDs, or required minimum distributions. Our industry loves acronyms, so we're going to stick to RMD because it's a lot shorter. But the biggest question, what is an RMD? An RMD stands for the required minimum distribution, and that's the amount that you have to take out, the minimum amount that you have to take out of a retirement account when you turn age 72. Now, I will tell you that in the year 2020, this is kind of a moot point because the CARES Act basically stated that the RMDs for 2020 are not being required to be taken. So we do kind of get a pass on it, but I still get this question all the time. So I thought it would be a great educational topic for everybody. And this way we're ready for next year when it kind of gets reinstated. But anyway, when you reach the age of 72, you must begin to draw funds from your traditional IRA accounts and your qualified retirement plans. Qualified retirement plan could be a 401k plan, it could be a 403b plan or 457 plan, and KEO plans. Also in that grouping are SEP plans, which are simplified employee pension plans. And also, we don't want to forget about our simple IRA plans as well. So all those plans have to abide by the rule where they have to take a minimum amount out to satisfy this required minimum distribution. But now keep in mind though, if you're still working at age 72 and your company, you're enrolled in the company 401k, 403b, or 457 plan, your distribution can be delayed until your retirement. So definitely want to speak to someone about that. Use your tax accountant. Also speak to your financial advisor about that. Get a little bit more direction on it before proceeding. So why do we have to take required minimum distributions? Well, it's to assure that the money in your accounts are eventually taxed. So basically, layman's terms, Uncle Sam wants his money. He wants a piece of your pie. Most of that money has either never been taxed or, taxed very minimally before you put it into an IRA. And the money has grown over many, many years in most cases. So now you have a chance for the government to say, okay, well, we want our little piece of the pie. So you have to start taking distributions. I mean, that's really kind of what happened. So then the next question related to the RMDs relates to how do you calculate the RMD, the required minimum distribution? Generally, to calculate your RMD for the current year, you divide your year-end retirement account value from the previous year, so in this case it would be 2019, by a factor that's found on the IRS Uniform Lifetime Table, and you can find that by going to irs.gov. It's a publication that's listed right there. It's in the publication 590. But as a person gets older, essentially the required minimum distribution percentage increases. And let's go through two scenarios. We have Jane, who is 72, so it's her first year. And assuming she had to take her RMD, she has a $400,000 retirement account. And now granted, that could be spread over several accounts, and that's the total of all the account values at the end of the year. And I'm using, round numbers just because it's easy math. But what we do is we take that $400,000, we look at the chart on the 590 from the IRS website, and it says, okay, well, Jane's 72, so the factor that we're going to use is 25.6. So $400,000 divided by 25.6, lo and behold, Jane's required minimum distribution is $15,625. Okay, so that's what she would have to take out to satisfy her RMD, her required minimum distribution. Now, Jane, of course, has a friend, and her friend's name is Ann. Ann also has a 401k or retirement plan value of $400,000, but Ann is 82 years old. So Ann's distribution factor would be 17.1. So again, you do the calculation, $400,000 divided by the 17.1, it gives Ann an RMD amount of $23,392. So you could see, different ages gives you a different divising factor and gives you a different required minimum distribution. Your required minimum distribution will most likely change every single year because your account value is going to change at the end of the year, as well as your divisor is going to change every year because you're a different age every year. Now, don't forget, both Jane and Ann will have to pay taxes on their distribution from their IRAs or their retirement accounts, but that's the object of the exercise as far as the IRS is concerned. They want they want their tax dollars, their revenue. So now I kind of mentioned this already. What if you have more than one IRA account? You can have several IRA accounts and calculate each one separately and then take each RMD out of each account, or you can calculate all those numbers and just take it out of one account. It doesn't matter where you take it from, which IRA account you take it from. The difference there is that you just have to make sure that you take that minimum distribution amount out. You can take more, you just have to make sure you cover at least that minimum, because if you don't, it is a whopper 50% penalty. So if you were supposed to take, $10,000 distribution and you didn't, guess what? You have to give Uncle Sam $5,000. Not a fun conversation to have. So make sure you don't fall into that one. So the one thing where I was talking about was, the IRA plans where you can, count them all up and take them from one or each plan. The difference is that's okay, but if you have your money still in an employer plan, like a 401k plan or some other type of employer plan, the RMD rules are a little bit different. You cannot aggregate your RMDs from multiple employer plans. Your required minimum distribution from each plan must be separately calculated and withdrawn from that plan. So I can't say, oh, I have an old 401k here and an old 401k here. I'm going to add up the numbers and just take it from over here and let that one go. You're not allowed to do that. You have to calculate each one and take that minimum out of each one. So you do have to be careful about that. Now, the one other difference, again, I'll mention is if you are still working and you're over 72, you do not have to take an RMD from the current plan that you're, the employer's plan that you're working for, unless you are 5% or more owner of that company. So if you're not an owner of the company and ownership is 5% or more, you can defer your RMD as long as you're working, even after 72. RMDs on beneficiary accounts. So if you inherit, this is a beneficiary account is someone passed away, they had an IRA and named you the beneficiary. You may now hold that account as it's titled as a beneficiary IRA in your name. And you also have to take assets out of there every year. And there's a calculation, it's very, very similar. It's pretty much the same idea for how you calculate your distribution as well. Now, spousal beneficiaries have a choice whether or not to roll the assets into their own IRA immediately, to roll later, or to leave the assets in a beneficiary IRA and take the RMDs from the account when required. You do have to make a decision, take into account the beneficiary's age and need for assets, access to the assets for the account. But you should really talk to your investment advisor, your financial advisor, and your tax person before making those decisions. Because sometimes there are advantages and disadvantages of, rolling the IRA depending on the options, the services, the fees, things like that. So you do want to be careful. The other thing about spousal beneficiaries who are younger than age 59 and a half, who need or want access to the IRA assets, may avoid early distribution tax penalties by maintaining the IRA as a beneficiary IRA. And that way the early withdrawals are not subject to that penalty, which could be usually about 10% penalty if you try to take money out of one of those types of accounts, of an IRA, basically before 59 and a half. Now, non-spouse beneficiaries are not permitted to roll inherited IRA assets to their own IRA. That is where they would take the distribution of the inherited assets and put it into a beneficiary IRA. Most non-spouse beneficiaries must fully deplete the inherited IRA by the end of the 10th year after the IRA owner passes away. That is a new law that was brought about with the Secure Act. So you now have 10 years as a non-spouse beneficiary to deplete that IRA. Now, disabled beneficiaries, chronically ill beneficiaries, people who are not more than 10 years younger than the decedent, and the IRA owner's minor children or minor designated beneficiaries, they can have the account a little bit longer. When you are a minor, that 10-year rule does not apply, but once you hit the age of majority, then it switches over to the 10-year rule. So we'll have to, be careful that if you're listing children, minor children especially, as your beneficiaries. There's a 5-year rule as well, then that all the assets must be distributed within 5 years. That generally applies if there's no designated beneficiary, or if the beneficiary is a trust, a charity, or an estate, and the owner dies before the required beginning date. So you just want to be careful of those little things as well. So that's pretty much a wrap on the required minimum distribution conversation today. Feel free to call me, email me for questions. Again, my email is reginahess@forgewealth.com. Please visit our website at forgewealth.com and follow us on Twitter, Facebook, and YouTube at Forge Wealth. And on LinkedIn, I'm at Regina McCann Hess. Thanks for tuning in, and we will see you next week.